will talk about trade finance. I will have only one key message for you today, but it's going to take me a while to explain what this key message is about. So key message is the following. Trade finance has been said to be low risk over the past decades. It is indeed low risk, and ICC has been able to evidence it. We have been trying to evidence it because we have been seeking a fair treatment under the Basel regulation, and we have been achieving something, and I will explain what I mean here. Before, a few words on ICC. ICC, it's a business organization. It's a worldwide business organization. We are headquartered in Paris. We have 92 offices in the world and 10,000 of businesses as members. I'm managing the Banking Commission. The Banking Commission is a group of about 600 banks from 85 countries, and we are mostly involved in rule setting, creating guidelines and standards for the trade finance industry, in market intelligence and policy making. And policy making over the past 3 years or even more has been mostly related to the Basel issue and to some extent to KYC AML issues as well. Policy making has been consuming about 80% of my time on Basel issue over the past years. Just to say that this is an important topic for the banks worldwide. Before I get started on the regulatory environment, I just want to drop a few statistics very quickly. If you look at this slide, you see that world trade export is quite significant, and you know it. It's about 18 or a bit more than 18 trillion US dollar per year, and here you get a split of world trade per region, with Asia being quite big today, followed by Europe and North America. In terms of the trends, you see that it has been on a regular trend, except with a downside in 2008. But trade is picking up again worldwide, and it's going to continue to do so most probably, and that's what many people would expect. So if you look at here the trend in terms of world trade and the breakdown, open account on one side, and letter of credit on the other side. Clearly, first of all, you see that world trade is going to increase significantly in the next 10 years and more. And you see a second trend. Open account is supposed to be growing as well. And whatever else we call traditional trade finance, which is letter of credit, bank guarantees, standby, import loans and so on, will probably be on the low side or decreasing to some extent. Global trade is expected to reach about 50 trillion by 2025. And here you see some statistics as well to see where where trade is taking place. Mostly statistics are between 1990, 2000, and 2009. So you have clearly Asia, which is growing a lot, followed by Europe, and Africa is picking up really significantly as well today. A lot of things are happening in Africa. Globally, South-South trade will become more important in the next few years. By 2020, South-South trade should be about 30% of global trade. All this is supported by trade finance. Traditional trade finance, as I mentioned, letter of credit, documentary collection, but also receivable financing, pre-export finance, warehouse finance, and so on. And that's what we are talking about here. We are talking about trade finance, short-term finance. And this is a critical lubricant for trade and the real economy. About 80% of trade flow requires some financing at least at one point along the chain that you see here. However, having said that, this is a rosy picture, right? I'm telling you that global trade is increasing. is going to continue to increase. I'm telling you that a big part of world trade is supported by trade finance. If you take the LC, letter of credit market, it is estimated that about 20% of world trade is supported by documented credit, letter of credit. So that's a big volume in trillions of dollars. But still, I see a few constraints on trade and trade finance today. I want to mention just a few. Not all of them, but just a few, and I will concentrate on the Basel issue. First of all, you have this new environment compliance issues. You, the bank, you have to deal with KYC, AML requirements, which are becoming more and more strict. Today, if you do business and you go to do business in many countries of the world, you have to do due diligence with correspondent banks. If you are a big international group and you go to do business in Pakistan, potentially you end up doing on an annual basis 80, 100 or more due diligence, costing each of them probably above $100,000 and requiring a lot of resources, financial and human resources. And that's because of the new regulatory environment, KYC requirements, AML requirements, and so on. So clearly, when you talk to major banks and major players, they are telling you that today they are becoming quite selective, right? They do not go into all countries anymore. Some countries, they decide not to go at all because the requirements are too strict and the risks are too high. And otherwise, when they go into some countries, instead of doing due diligence, CDD, and so on for 100 banks, they would do it maybe for only 10 banks. So they are becoming more selective. The second issue that you see, at least in Europe, is deleveraging. And deleveraging has been taking place for already 2 years, meaning that trade finance funding is less and less available as banks are clearly cleaning up their balance sheet. It is estimated, according to the IMF, that some $2.83 trillion will go into deleveraging by the end of this year. So that's quite a significant number, which goes into deleveraging and not in loans or support to the SME sector. Another issue that goes with deleveraging, it's clearly the lack of expertise, where banks become more selective, have less expertise, or decide to concentrate the expertise on some region or some products. Finally, the Basel requirements, that's a big issue we are facing, that banks are facing today with higher capital requirements. So let me now go into what I want to cover here in terms of what ICC has been doing with the Basel issue. You see here central banks putting liquidity into the system, prudential regulation squeezing the banks more and more. As a result, you have big risk and unintended consequences. One of them is SMEs not being funded in many countries or many regions, but also the emergence of a shadow banking system, some asset bubbles, and so on and so on. So what we've been looking at is the following. Back in 2008, the banks came to ICC to say, you, ICC, as a business organization, you should try to do something, and you should go to talk to the regulators. Go to see the Basel Committee on Bank Supervision, the BCBS, and try to explain that trade finance is low risk, and as a consequence, the Basel III framework should not apply to trade finance. That's what we did. We went to the Basel Committee, we knocked on the door, we had a few meetings with them, and they told us, it's very nice to meet you, but come back to us with strong evidence. If you can come back with strong evidence of what you say, we'll look at it, and we may be willing to consider some of your points. So that's what we've been doing. We put a group of about 25 banks together, international banks, the big ones, and we have been collecting trade finance, short-term finance, export finance data. Millions of transactions have been collected by ICC over the few years. We put it into a database, and we have been creating specific risk metrics, level of default for different products, different regions, over about the last 5-6 years. That's the first ever quantitative analysis of trade finance which has been done. We started to collect export finance characteristics back 1 year ago, so that is available as well today. Let me go to the results, that's what is more important. But before I show you which are the products that I'm covering here. Short-term trade finance on one side, import LCs, export LCs, standby guarantees, import loan, export loans. That's what you would find into this ICC database called the ICC register. Everything is online. The report is online. You can look at it. A new report has been released just a few days ago or a few weeks ago. So it's available online at the ICC website. On the export finance side, we have been collecting also different information on different type of loans, ECA-supported loans for different asset classes. Some of the results are really speaking by themselves. We collected, today we have 15 million transactions, but we have been analyzing about 11 million transactions last year. The level of default in 11 million transactions, it's only 3,000 defaults. 3,000 defaults. So the loss rates are very low, even in period of crisis and heavy stress. We were also able to calculate the average tenure per product. Here it's on average 90 days, and I will explain why it is important in a few minutes. Also, something important, the average recovery rate on written-off product is quite significant, about 60%. So let's look at the result. First of all, the implied maturity by product. You see here the different products, and you see that on average the maturity is 90 days. Why is that important? It is important because the Basel Committee were applying a 1-year maturity floor on trade finance products. So we were able to go to see the Basel Committee and tell them it does not make sense to apply a 1-year maturity floor. Let's look at it from what maturities are truly about. And that's something that has been given away to us. Today, the maturity floor is not applied anymore. You have a waiver on the maturity floor for LC product, according to the Basel Committee. And the CRD4, European CRD4, is going a bit further to say the maturity floor will be waived for all trade finance products. I just keep going with a few statistics, again on the same short-term trade finance product, LCs, import-export loans, and so on. Here, clearly, you see that the transaction default rate is fairly insignificant, 0.021%, right? And if I keep going here, you see the number of transactions that we have been looking at, and you see the number of defaulted transactions on the right-hand side with a percentage of default, and again, you clearly see that this is fairly insignificant. On average, just a few words on the variance for all banks, the 25, 30 banks providing data to the ICC register, you have a variance which is not significantly high. So all banks are having the same level of default, more or less, not a big variance. In terms of medium, long-term export finance, we reach about the same conclusion. If you look at the exposure weighted default rate, it's fairly insignificant. A bit higher, of course, than short-term trade finance, but still below the 1% threshold. So in conclusion, in summary, I wanted to tell you that ICC provided overwhelming evidence that short-term trade finance and export finance instruments present a low level of credit risk through the cycle. First of all, you have low default rates as compared to other forms of short-term lendings. You have low exposure at default and short economic maturity, low levels of loss given default, high recovery rate, and low rate of credit conversion from contingent to on-balance sheet exposure. More or less the same analysis would apply for export finance. The way forward, ICC clearly we have been calling to soften the impact of a number of aspects of Basel III on trade finance. And we have been getting some results. I mentioned the maturity floor. Today, you have an exemption of LC from the 1-year maturity floor. And the CRD4 European is going a bit further. You have also a reduction of the capital charge levied against trade loans to countries with low sovereign debt ratings. That has been given also to business a few months ago in January of this year. You also have a relatively favorable new guidelines on the liquidity coverage ratio given also to the business in January. However, on the leverage ratio, the Basel leverage ratio, we have not been achieving much. Today, the Basel Committee is applying a CCF of 100% when ICC and banks have been calling for a CCF of 20% or maintaining this CCF at 20%. Another issue of concern, of big concern, it's harmonization of the Basel framework. Today, how many Basel interpretation do you have? How many different frameworks do you have in place worldwide? I counted more than 6 today in place. Not mentioning that in many countries, in Africa, in emerging countries, many of them are still under Basel I, which is also creating a bit of an issue. And I mentioned to you CRD4, which is creating also a precedent in the sense that they're coming up with a less punitive treatment of balance sheet items such as trade finance. Unintended consequences, Stuart mentioned a few related to SME. It is a big concern. And here I would like to mention 2 studies. One was done by the ADB, Asian Development Banks, to demonstrate that you have a big trade finance gap taking place, not only in Asia, but worldwide here. And here are some values, some numbers I present to you. Globally, the value of proposed trade finance was about 4,500 billion, 4.5 trillion. The value of trade finance rejected by banks because they do not have the capacity to service business was estimated at 1.6 trillion. In terms of the Asian economies, the numbers is still very high. The value of proposed trade finance was about 2 trillion, and the value of trade finance rejected for the same reason, because of lack of capital, is significant, about 424 billion. This is clearly impacting export, production, and job creation. I would like to mention another study done by the IFC in 2010, which is a much more global study, but with similar findings, arriving at the conclusion that you have a big trade finance gap worldwide. 55 to 68% of formal SMEs in developing countries are unserved or underserved. The total value gap in credit financing of formal SMEs is about 1.5 to 1.8 trillion, including high-income OECD countries, by the way. How does it impact on SMEs? Well, here is one example. I was in Botswana a few days ago looking at the trade finance gap, and we were looking at some statistics. You see that you have about 8-9 banks in Botswana today services business, SMEs, but what they do, first of all, is to provide loans to household and not at all trade loans. You see clearly here the trade loans, which are this orange part of the graph, very small compared to total assets of banks or total offering of banks. So that's a big issue. Not mentioning that today in many countries of the world, if you do not provide as a business 100% collateral in physical assets or cash, you just cannot get capital, right? In Botswana, it was the case. You don't provide collaterals, there is no business, right? So that's clearly a big issue taking place at present time. Banks, or some banks, are quite conservative and impacted directly by higher cost of capital due to the Basel framework and other regulatory requirements like KYC, AML. Conclusion, 3 conclusions. First of all, ICC has been bridging the information gap in trade finance and creating a better understanding on how work trade finance and export finance. That's important because 10 years ago or less, 5 years ago, you had no statistics on trade finance, no reliable statistics on trade finance. And that was important to do so, to go to see the regulators. So in doing this ICC register database, we provided overwhelming evidence that trade finance is relatively low-risk asset class. And that was a major achievement because, as a consequence, we got some treatment, favorable treatment under the Basel framework. Finally, the ICC policy analysis provided a valuable leverage to engage into productive discussion with all regulators, not only the Basel Committee, but also government, national regulators. All these discussions have been taking place at the B20, G20 as well, with a few G20 communiques mentioning trade finance and seeking different amendments to the existing Basel framework. So that's what I wanted to tell you today. Again, my main message is the following: trade finance is fairly low risk and as such should not be penalized, as it is the case today under the Basel framework, especially under the leverage ratio. Thank you very much.